Hello everyone, and welcome to another edition of IronFX Viewpoint. I'm Marshall Gittler, head of Global FX Strategy here at IronFX. Well, it's a new year here in the West, so I'd like to wish a Happy New Year to all my viewers. I trust that last year was a successful year for all of you, and I wish you another year of health, happiness, and prosperity. I can't help you with the health or the happiness, but I hope I can make a contribution to your prosperity this year. We have the custom of making New Year's resolutions every year. For me, my resolution is to improve my videos as much as I can, to make them more useful for you, and to increase my viewership. I'd be grateful for any ideas that you have. Please send them to me at mgittler@ironfx.com. My teenage daughter kindly referred me to some of the people who she watches on YouTube, some of whom have over 1 million followers. She thought maybe I could get some ideas from their success. From looking at them, it seems that the best way to get viewers is to give out advice on makeup and hair care. Unfortunately, I don't think that's going to work for me. Well, today I'd like to look back at 2013 and see what worked in the FX market, and then look ahead and see what's expected to work in 2014. This table shows the total return from the G10 currencies in 2013. The first column shows the return just from the change in the price of the currency. The Danish krone and the euro are basically tied for first place, while the yen and the Australian dollar are at the bottom. Then there's the second column, the interest earned on the position. While interest rate differentials don't matter much for short-term trades, in normal times they can make a difference for longer-term trades. I say in normal times because interest rates among the G10 are so low, and the differences in interest return between currencies is so small that for the G10 currencies, this isn't a big factor. So, for example, the Australian dollar had the highest interest rate, but, as we saw, was the second worst performing currency. On the other hand, the Danish krone was the second best performing currency, and the Swiss franc the third best on a total return basis, even though interest rates for those currencies are not only at the bottom, but are actually negative. Probably I should turn that statement around. Those currencies aren't strong despite negative interest rates, but rather the interest rates in those countries are negative because the currencies are so strong. That's why the central banks instituted such radical policies to discourage investors from buying those currencies and pushing them up further. You can see the relationship between interest rates and total return better on this graph. It shows the total return for the year on the x-axis, the horizontal axis, against the interest return on the y-axis, the vertical axis. You can see that there are two main groups. The high-interest currencies that depreciated. These are the Australian dollar, Norwegian krone, and Canadian dollar. Then there are the low-interest currencies that appreciated. The euro, the Danish krone, and the Swiss franc. By the way, this is what makes carry trades dangerous sometimes. If you had put on a G10 carry trade at the beginning of the year, buying the 3 highest yielding currencies and selling the 3 lowest yielding ones, you would have lost around 5.7%. Now, there were 2 major anomalies last year, the yen and the New Zealand dollar. The yen was a low interest rate currency, yet it depreciated. On the other hand, the New Zealand dollar was the second highest interest rate currency, and it appreciated. So, what's going to happen this year? Taking the market consensus forecast from Bloomberg, here's what investors in general are anticipating. The column on the left, the spot return column, shows that the market expects all the G10 currencies to fall in price against the dollar. In other words, the dollar is forecast to rise against all its G10 counterparts. With interest rate differentials so low, most of the return will be price return. If you look at the right-hand column, only in the case of the Australian dollar and New Zealand dollar is the interest return enough to offset the loss from the expected price decline and turn the expected loss into a profit. Otherwise, the total return on the currencies is expected to be almost the same thing as the price return, and the ranking of the 2 columns is almost exactly the same, with the exception of the New Zealand dollar and Canadian dollar. What's driving these forecasts? Well, we can see from this graph what it's not. It's not mean reversion, nor is it momentum. This graph shows the actual return on 2013 on the x-axis, the horizontal axis, and the forecast return in 2014 on the y-axis, the vertical axis. Sometimes it's the case that the currencies that do particularly well one year do badly the next year, as the factors that boosted them before fade. That's mean reversion. On the other hand, sometimes the currencies that do well one year continue to do well the next year, as the factors that boost them continue. That's momentum. But in this case, I can't see any pattern here. Some of the currencies that did well last year are expected to do badly this year, but at the same time, some of the currencies that did badly last year are expected to do badly again this year too. However, if we look at the same data we've been looking at in a different way, a relationship does become clear. This graph again shows the expected return for 2014 on the y-axis, but in this case, the x-axis is the interest return from 2013. Now, there's a very strong relationship. The R squared is 0.76%, meaning that the interest return explains 76% of the variation in the forecast 2014 return. Currencies with higher interest return are expected to do better this year, and the currencies with lower interest rates are expected to do badly. Why is this? Why is this when, as we saw, there was an inverse relationship between interest return and currency performance in 2013? It's probably because the market is expecting continued normalization in the global economy. One reason why the low interest rate currencies gained so much in 2013 was because investors were looking for safe havens. Denmark, with a current account surplus of around 6% of GDP and only a small budget deficit of 1.7% of GDP, seems pretty safe. Switzerland, with a current account surplus of 12.7% of GDP and a balanced budget, seems even safer. But apparently, people have become more confident about the global economy and are now less concerned about safety. This is probably because so many things we worried about haven't come to pass. The Eurozone hasn't collapsed yet. The U.S. government didn't default. Quantitative easing didn't cause hyperinflation. The Fed's exit from quantitative easing didn't cause the emerging markets to implode. Many of the major problems that were facing the markets at the beginning of 2013 seem to be under control now. In that case, people are going to start looking for some return on their money. They're likely to put on carry trades funded with the low-yielding currencies of countries whose central banks aren't likely to change monetary policy anytime soon, and invest in the higher-yielding countries where the central banks are at least going to keep rates stable and may raise them at some point. Now, I'm not saying that I agree with all these forecasts. On the contrary, I disagree with many of them. But that's where the opportunities lie for a fundamental analyst. We have to examine where our forecasts differ from other people's forecasts and ask two questions. One, are they right or are we right? What possibilities might we be missing, and what might the market be missing? And secondly, do we have enough confidence in our view to back it with money? That's the way fundamental investors work. In coming presentations, I'll be referring to these market forecasts again, analyzing what they're based on and where they might be wrong. This should give you a better idea of where your vision of the markets differs from the consensus and where the opportunities for you to make money are. Any questions? Comments? Please feel free to message me at mgitler@ironfx.com or get in touch with your IronFX representative. This is Marshall Gittler, head of Global FX Strategy at IronFX, wishing you solid trading.